Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. We have a currency in this country. It is called the dollar. How much is the dollar worth? Well, it's all relative. Depends on where you go in the world. Right now, it is worth about 89 cents in the euro, or it is worth about $1.36 of the Canadian dollar. And the value of currencies are determined in the global market. They are traded 24 hours a day. And there's basically three centers in the world where we trade currencies. First, they trade in Tokyo overnight, and then the trading moves to London, and then the trading moves to New York. And New York is probably the biggest. And we're going to call gold a currency too, but we'll get to that later. And Bitcoin is also a currency, but we'll get to that later. What do all currencies have in common? Well, number one, they are a medium of exchange. And what that means is you can use them to buy things. And this may seem super obvious, but we're going to go through this exercise anyway. If you wanted to buy a pizza and the pizza is $15, you use your dollars to buy the pizza. You can use your dollars to buy, I have these Beats headphones next to me that I just bought. This can of nicotine pouches. All of this is bought with currency. They are a medium of exchange. You can use them to buy things. Also, they are a store of value. Okay, so if you had $20,000 in cash and they were sitting in your house, if they sat in your house for 10 years, theoretically, they would retain their value over time. Now, we have inflation, which erodes the value of the currency over time, but inflation has been pretty low, so we haven't had to worry about inflation for a while, but they are a store of value. Now, there are other things that are a store of value. Gold is a store of value. Bitcoin is a store of value. Cars are an imperfect store of value. A house is a store of value. But a currency is supposed to be a store of value. They should hold their value over time. And number three, they should be a unit of account. They should be divisible, and this is how we have prices for goods. Now, I mostly focus on the store of value part. And I like to think about the dollar in particular. If I have $10,000 today, what can I buy with that money today? What can I buy with that money 5 years from now? What can I buy with that money 10 years from now? I know that the price of a new car when I was born was $4,000. Today, the price of a new car is $36,000. Over the course of 46 years, the dollar has not been a great store of value. By the way, a lot of currencies haven't been a great store of value. And if you've ever met somebody who is a gold bug, if you've ever met somebody who's really into gold, this is the problem that gold solves, because gold is an objective store of value. And gold holds its value over time. We'll talk about gold some more later. But what gives a currency value? How do you value a currency? It's easy to value a stock. You look at the balance sheet, you look at the income statement. It's easy to value a bond. You look at the coupon payments. You can value securities, but how do you value a currency? It's very subjective. And the way I think about this is it's the productive capacity of all the people in the country in a given year. It's the sum total of all the goods and services produced by people in the country in a given year. It's the strength of the economy, basically. It's the strength of the economy. So countries that have a strong economy generally have strong currencies. Countries that have weak economies generally have weak currencies, and they get weaker and weaker. But basically, it's the productive capacity of all the people living in the country. Now, the other way that you value currencies is with interest rates. Interest rates A country with high interest rates will usually have a stronger currency. So if you buy that currency, what you can do is you can deposit it in a bank and you can earn interest on those deposits. So countries with high interest rates generally attract a lot of capital because people can buy those currencies, put them in the bank, and earn interest. If you have a country that has low interest, it's generally less attractive, but there's all kinds of exceptions to all these rules. I mean, we have 0% interest in this country, and yet our currency is still pretty attractive. We have negative rates in Europe, and their currency is still pretty attractive. So there's all kinds of exceptions to the rule. But a country with low interest rates will generally have a weaker currency. In practice, currencies move with changing interest rate differentials, and that's a word salad. But what that means is that let's just have a hypothetical example where you have U.S. and Canada. If interest rates are 2% in the U.S. and interest rates are 2% in Canada, if they're going up to 3% in the U.S. and they're going down to 1% in Canada, that should mean that the U.S. dollar would appreciate relative to the Canadian dollar. So it's about the movement of interest rates. And people who trade currencies for a living, they are very much focused on the politics of the countries that they trade, and they're very much focused on the monetary policy of the countries that they trade because they are trying to predict the movement of interest rates. So it's about interest rate differentials. Now, in practice, interest rates in the developed world are pretty much zero everywhere. Interest rates are pretty much zero. So this doesn't really matter as much anymore. So what makes a currency get stronger or weaker? Well, even though interest rates are zero, there's other aspects to monetary policy. For example, we're doing something in the United States called quantitative easing. We're printing money. That's actually what we're doing. We're printing money to buy treasury bonds, corporate bonds, stuff like that. And other countries are doing this too. Europe is doing this too. Japan is doing this too. So, now everybody's interest rates are zero. Everybody's doing quantitative easing. And we are all doing radical monetary policy. But if you think about this idea that the value of anything is determined by supply and demand, and if we are increasing the supply of dollars, it theoretically should make the price of dollars go down. And like I said, people who trade currencies know a lot about politics and monetary policy in the countries they cover. For example, I know a guy who trades Latin American currencies at a bank. He knows everything there is to know about Mexico. He knows everything there is to know about Brazil. He knows everything there is to know about Colombia, Argentina. You have to know this stuff. Now, there are other factors, too. So right now, we're also looking at deficits. So big budget deficits will also have an impact. Fiscal discipline has an impact, as well as political turmoil. If you're looking at emerging market countries, if you're having an emerging market country with political turmoil, that also has an impact. These are all things that are happening right now. Now, I said I would get back to gold. And is gold a currency? Well, I said it is an objective store of value. It holds its value over thousands of years. It holds its value over thousands of years. It is definitely a store of value, but it is not really a medium of exchange. You can't buy a pizza with gold. You can't buy these Beats headphones with gold. You can't buy this can of nicotine pouches with gold. It's not good as a medium of exchange. I mean, you could do that. You could do that. I mean, theoretically, I've always wondered if you could do this. If you could take $30,000 worth of gold and go to the car dealership and buy a car with gold, that would be really cool. I think that would be a really interesting exercise, but I don't know that anybody's going to take it. It's also hard to pay for things with Bitcoin. Right? Bitcoin transactions are pretty slow. They can take up to 60 minutes. And it's not really practical as a medium of exchange. It's called a cryptocurrency. It's theoretically a currency, but it doesn't really behave like a currency. It really behaves like an asset. But the store of value is very important. Now, countries are trying to devalue their currencies. Why would you want to do that? And the answer is because if your currency is weaker, you get to export more because your goods are cheaper and your manufacturing runs hotter and people get to have jobs. This is why some people like to have weaker currencies. And Trump is obsessed with having a weaker dollar, but it actually hasn't really happened in his presidency. The dollar has been somewhat strong. The problem is that all countries are trying to make their currencies weaker at the same time, which is good for gold. Gold will appreciate against all currencies simultaneously. Now, historically, we didn't always want a weak currency. If you go back to when Bill Clinton was president, Robert Rubin was the Treasury Secretary. He always said we want a strong dollar policy. We have a strong dollar policy. So for years, we had a strong dollar policy. And under a strong dollar, businesses are very disciplined and they have to cut costs as much as they can to be competitive globally. Right now, businesses are very flabby because they can export very easily. Again, when all currencies get weak, it is good for gold, and gold is doing pretty well right now. Do I have a prediction for what the dollar will do in the future? I think the dollar will get weaker. I think our monetary policy will get more and more radical, and we will print more and more money. There are a lot of people who predict that it will get stronger. They say something about how we have a shortage of dollars or something like that, but I just don't get it. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.